Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And I'm here each and every week to help you create a better relationship with your money because after all, your money matters. Friends, today I'm going to go into and share with you 10 rules and basics about money. Things about money that I want everyone to know. I wrote a list the other night of things I talk about constantly on the show here, as well as with clients. And I wanted to filter it and I wanted you guys to share this. I want you to talk about it. I want you to reach out to us because we can go through it together. But I want to share some things that are really important when it comes to not just managing your finances, but also just understanding money in a better way, both on the daily and on the yearly and ultimately for your retirement, especially as we kick off the new year. All right, let's get into it. You've heard me say it 1,000 times. Having a structured plan is so important when it comes to your money. And what should come with that are principles we all should implement on our own outside of maybe those review meetings or strategy meetings you're having with your financial advisor or that financial advisor provides. Because let's face it, it starts with you. It also ends with you. You are a large part of this puzzle. George Clason once wrote, "Money is plentiful for those who understand the laws which govern its acquisition." He wrote that in his book, The Richest Man in Babylon. Now, interestingly, although it was set 4,000 years ago, the book in ancient Babylon, it was actually written in 1926 and was based on George Clason, the author, his real life lessons and experiences. And the message of this book, which by the way is a great book, I've read it multiple times. I actually learned about it first in economics school. But the message of this book was very simple. Work hard, improve your skills in order to ensure future income because wealth is the result of a reliable income stream. Friends, you cannot arrive at the fullest measure of success in any sort of success, regardless of money or just success in life, until you absolutely crush the spirit of procrastination within you. And with that in mind, here's the number one on my list. And this is not necessarily order, but I wanted to show you the 10. But number one is this: pay yourself first. Basically, as soon as you get paid, put money into savings first, some sort of savings account. Now understand that if you automate this, that's even better. Now, obviously we need to put that in context with debt, but make sure you're putting money aside for yourself for tomorrow. Remember that your future, whether you want to call it retirement or just living financially free at whatever age that is, relies on a lot on what you do today. I mean, this whole thing about procrastination, my statement earlier, has a lot to do with any success you're going to have, any hit list you're making the start of this year on some New Year's resolutions or whatever it might be. You got to make sure you follow through with it. Action is the actual implementation of any sort of goal. Motivation is easy. I talk about this a lot. Like you can get motivated by 9 a.m. with a cup of coffee, right? Talk to me at 3 p.m. when you're having your sluggish afternoon. Are you going back to your disciplines, going back to your set of rules that you've set out for yourself? Because that's how you get through the year. Now, number 2 on my list is keep an emergency fund. So the rule of thumb is 3 to 6 months. So if you've got, let's say I'm making this up for a second, $5,000 of overhead, you should keep somewhere between $15,000 to $30,000 of cash. Now anything above that, in my mind, in planning world, becomes excess cash. And really, I want to share this openly with number 2, that in times of inflation, you probably want to find, a really good money market account and make sure you put it in there if it's above your threshold of a good rule of thumb, again, 3 to 6 months, but then also your comfort level. So not only is it paying yourself first of things to understand about money when you're thinking about it first, like how do I set aside my monthly budget, Brad? Kind of what am I looking at? I have some rules coming up here as well, so stay tuned on that. But pay yourself first and then make sure you have a reserve fund, your rainy day fund. This could be your Vegas fund. This could be your fund, whatever that might be, but make sure that that's set in stone. And the rule of thumb there, 3 to 6 months, albeit you want to go up to your comfort level so you can do that as well. And again, both of the first two I just mentioned, does need to come in context with your debt. And that's where you talk with an advisor to kind of figure out, how that works there as well. Number 3, create a budget. So ironically, again, this isn't any chronological order for a second here, but paying yourself first and putting a cash set aside, creating a budget is in line with all of these, frankly. Look, there's a couple rules of thumb here that I think is important within number 3. I believe in the 80-10-10 rule. It's a good one to go off of for any of you thinking right now of how much am I supposed to put where. I talk about it a lot with young people in particular, but anyone can use this right now. 80-10-10, live on 80% of what you're bringing in, save 10% for short term and 10% for long term. Now, really quickly, the difference between short term and long term for a second is that cash piece. So short term in my world, I kind of show as anything less than 2 years that you might use something for. Again, the account, the trips to Vegas or whatever it might be, some fun, some travel, things like that. Anything beyond 2 years and really leading up to maybe 20 or 30 years, like the longer time horizon, becomes your long bucket. This is where your 401ks come in, your IRAs, SEP IRAs, 403bs, whatever role of work you are doing, that's where you utilize your retirement plan savings. Now, obviously, you can play with those numbers to get a little bit more aggressive with your savings. And in doing so, number 1, as I mentioned, you're paying yourself first. So you can reduce the 80% down, to 70 maybe. You do 70, living on 70%, saving 20 for short term and 10 for long term, or flipping those. So you can rearrange those that works for your lifestyle. But I get a lot of questions sometimes from people who call in from the show, from our radio program, from things like that, that one of the basic questions for many is, where do I start? Like, well, how do I even look at where to put things and and how much do I put where? Number 4, and by the way, this entire list I want to share is for anyone and for everyone. And what I mean by that is whether or not you're an entrepreneur, a freelancer, you're a W-2 employee for a small company, large company, doesn't matter. Maybe you're an athlete who's worked for 4 years and now you're retired. Literally anybody can use these 10 I'm going to list out here. But this number 4 I want to bring up is about overtime. And this can be mostly for maybe your W-2 salary employee who has overtime or bonuses, but it's also holds true just the same for a self-employed person, an entrepreneur, or a freelancer who sets aside money within the business and then pays themselves afterwards, right? Is you want to divide your bonuses, all right? So the way I look at it is this way. I call it a third, a third, a third, right? 1/3 for fun, 1/3 for retirement, 1/3 for debt payments. Now you can rearrange those how you want to, but I think that's a good starting point and a great notion to take hold of, especially as you get maybe an increase in pay as bonuses. Not only do you get a bonus at the end of the year, maybe for what you're doing, but also just a general pay increase on your salary. Maybe it's a promotion, anything like that. Take any increases you get and think a third, a third, a third. A third for fun, which by the way could be your short-term bucket. So all these rules I'm bringing up play on each other, right? So a third for fun would be your short-term bucket, right? A third for retirement is that third bucket, that long-term time horizon. And I put that other third in there which is paying debt, because all of us have debt. And I think that's really important for us to talk about. Like the fact that you might have debt, we tend to kind of go inward in our shell thinking like you did something wrong or you're not doing something right on the go forward. And the reality is that's just not true. I mean, I'm speaking myself as an advisor of nearly 20 years now, working with thousands of clients across this great nation. We manage nearly $5 billion for clients. And I can share with you that a high amount of those clients all carry some sort of debt. So I put that third in there for debt repayment because it's also what we talk about a lot and if you've watched our show on how to pay down your debt, how to avoid and pay down debt of any amount, you can go to that show. It's a great one. We talk about this. We talk about the snowball or avalanche effect. So you can use that 1/3 of any bonuses or any pay increases to add to your avalanche or snowball method. All right, number 5, when at all possible, speaking of debt, avoid high interest debt if you have it. Again, look at the avalanche or snowball method to pay it off. Talk with your advisor about that. Reach out to us. We can build you a snowball or avalanche method. Don't even know what I'm talking about? Google it. Believe it or not, you can actually find some things on that kind of thing. And I've done this method with many clients. And here at One Capital, we actually create a spreadsheet to help our clients with that. And most people think that when paying debt down, they're trying to pay either the largest balance or maybe even the smaller balance just to get rid of it. But in reality, you shouldn't be looking at the balance so much as you should be looking at the interest rate. You want to avoid high interest rate debt. Now, you notice I just said high and it's not real, it's more of a general term. The reality is if you have, let's say, a credit card, a student loan, and maybe a mortgage, as an example, which a lot of people have, for example, typically anything unsecured, and by unsecured, I mean it's not backed by an asset like a credit card, they carry the higher interest rate. Whatever the balances are of those three that I mentioned, you want to focus on the highest interest rate first because that's what's costing you the most money. You're paying Visa, MasterCard, or some bank a high interest to hold your debt. So any monies you're putting towards there, you want to use it for that. Now, a snowball method and an avalanche method, just a quick insight into that, is once that debt's paid off, the payment you're making there, you don't bring that back into your income. You actually take that and then attach it to the next highest interest rate debt. And that's how you start reducing and shorten the time period of which you have debt. And you know what, friends? The biggest thing I'll share about that, it gets you out of the mental tailspin that I think people get into sometimes around debt. They're thinking, I can't get out of this. Then they start going to debt consolidation, and you're really just kicking the can down the road. When in reality, if you stare it in the face and you actually look at it, meet with someone with an advisor who can help you with this, you can, and I promise you, you will take care of it. And all you have to do is create some discipline around that. So number 5 is more of a blanketed statement, but I needed to share it. I needed to put it on this list of avoiding high interest rate, or said differently, if you have a high interest rate, tackle that one first. Okay, number 6, contribution rates. Now I mentioned this in a previous show about contribution rates from last year, from 2022 now into 2023. And contribution rates I want to talk about really in terms of that long-term bucket. And what I mean by that again is 401k, IRA, things like that. So real quickly, in 2023, being that we're in January right now, kicking off the new year, for any of you that are putting money into a 401k, for example, the limit of how much you can contribute went up from $20,500 last year to $22,500 this year if you're under the age of 50. And if actually you're over the age of 50, you're actually able to do another catch up, which almost gets you to a $30,000 of contribution each year, which is incredible. So make sure you take advantage of that. You want to look at your pay stub right now. A good action item on number 6 here is take a look at your pay stub, figure out your cash flow, see any bonuses you received last year, follow those rules of a third, a third, a third, and then look to add more there. Look to see if there's cash flow that was available, because now is a great time. We're going to talk about this for the next 4 here for a second when it gets in the investment side, but now is a great time. When you look at volatility, as I've shared many times before, you want to look at volatility as a good friend to you, not a foe. And what I mean by that is you want to start buying along the way. And if you can move more fresh capital into a volatile market like we have, and we're probably going to continue to see some volatility throughout this year. We're obviously off to a great start, 2023 in the markets, but it's not going to be without its ups and downs. And so you want to kind of dollar cost average into the year, dollar cost average into the market. And if you are maxing out from last year, make sure you know that the increases actually went up. And if you're not maxing out and you're kind of looking at me like, Brad, $22,500 a year in retirement seems crazy. Well, again, go back to the rules I just mentioned. Look at your budget. Look at the 70-20-10 or the 80-10-10 rule. Look at the bonuses or maybe increases in pay for last year, the third, a third, a third. And you'll find that you don't have to give up on current lifestyle to hit some of these goals. And really, it's one of those things where I share with clients all the time, let's walk, not run. And what I mean by that is, let's not get the January or the 9 a.m. coffee motivational buzz and just want to kind of get into knee jerk and just build all this stuff. Do it over time and set systems in place for you so that, come July of this year at 3 p.m. in my dumb examples, you're still doing the same thing you're doing the middle of January when we started talking about this. And so that's how we start building our systems, that this list of 10 rules of money and just 10 things that I've spoken about so much in my practice over 20 years that I wanted to boil down into 10 main things and share with you on the show today.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Okay, number 7, your mortgage payment. Many of us have it. In fact, the majority of Americans have a mortgage payment or some sort of payment as it relates to your living or housing. And we just talked about this last week on the Make Your Money Matter show. We did a whole housing outlook for 2023. And I shared that last week largely because really, Most of the reviews I've been doing in the past year or two, housing has been a large conversation. Again, there's like three camps I brought up. You either own a home, right? And you're going to keep that low interest rate. You don't want to look to get out of it. Or maybe you own a home and you refied a couple of years ago at really cheap money and you've been sitting on the sidelines with cash looking to buy. So you're concerned where, houses prices are going to go. Or you're in the third camp, and this is not in any order, that you are looking to buy. You're renting right now and you're looking to buy. And so housing is a big deal. So this is how we start thinking about some rules of thumb when it comes to your mortgage payment. And I was thinking about it, and I get this question a lot, but there is something in our world we call PITI, and that's principal, interest, taxes, and insurance. Now, all of it, as a rule of thumb, should be somewhere between 25 to 30% of your monthly income. So if you're ever thinking, is this too much, like your mortgage payment or your rent, or you're thinking, can I afford it? Take a look at that stat. I think that sets the tone for a budget item. And a quick example of that would be, if you have $5,000 a month coming in, as an example, your housing, your mortgage, your rent should be somewhere, around $1,500, $1,800, give or take a month, which then leads, the other 3,000 plus there for other things, debt payments, cash flow, savings, investments, what have you. So when it comes to mortgage, the rule of thumb there is principal, interest, taxes, and insurance, somewhere between 25 and 30% of your income is a great place to start. Obviously, you can move those things around. I have a lot of clients who have 10%. I have a lot of clients who have 50%. So it just depends on your tolerance, as in most things in this world. Depends on your tolerance level. But that's the Certified Financial Planning Board, the CFP kind of standard rule of 25 to 32 or 28 to 32. I kind of boil it back down to 25 to 30. I think it's a good place to start. All right, number 8. I think it's very important. If we're talking about a house, we're going to talk about another big asset that most of us have, a car, and buying a car. And I think it's important to bring this up because I talk with clients a lot. And again, this show is born out of 20 years of working with clients, and I want to share a lot of these items that come up. And I talk to them a lot about buying, leasing, financing, and what that means for you for a car. Now, there's different variations for everybody, but here's a rule that I think is really important and I want to share to you. 24-10. That's what I'm going to call it. That's how I use it. That's what I share with clients. On our radio program, I share this a lot. And on our show here, I want to share that. 20% down for a 4-year loan that ultimately becomes less than 10% of your monthly income as your payment. So 24 and 10. And I think for most, to be completely candid, I still like buying older vehicles with cash. I think that's just a better value in general, but it depends on your style of car and your travel and how you perceive your asset there, right? The break even, real quickly, for most analysis that we run is if you own a car more than about 7 years, it actually might make more sense to buy it versus leasing it. Typically a lease has a lot to do with the travel distance, and frankly, for some people, they just like a new car every couple of years. So I just kind of like to, there's variations to that answer, but the rule of thumb I like to use that I wanted to share was 20% down, 4-year loan or lease, and less than the ultimate payment becomes less than 10% of your budget. So for any of you thinking, is this too much car? Can I afford this? Just like the house of 25 to 30%, you start looking at now you bake this one in there of less than 10%, and then all of a sudden you have more set aside for other things, again, savings, investing, cash flow, the fun in life necessarily. It also a little bit answers the question about buying versus leasing and financing. Again, 7 years is a good break-even analysis on that. So that's why I wanted to share that aspect of it. All right, number 9, we're gonna shift over to investing for a second. Let's just talk about it, the stock market. Look, if you look at the whole of the stock market, the average of the market has roughly a return of over 10% annually. I mean, there's a lot of reports on this. The S&P over the last 30 years, a little over 10%. You can look at different time periods, but it in general has a high rate of return over time. So to calculate your returns, if you're looking at assumptions, whether in your 401k or maybe just an individual brokerage account, it's common to use 6 to 8% in order to capture the effect of inflation, and just in general, that's kind of more of a conservative number. And I think a good compound interest to be really conservative actually might be 5, but just know this, my statement about this on number 9 is long-term investing pays off and discipline works. I've said this before, I'll say it again. I know it's not the sexiest thing in the world. I know it's not the most fun thing in the world to talk about, discipline, but it does work. So in saying that in number 9 about the market's overall time period and overall rate of return, keep a longer view focus when it comes to your investments. That's the biggest thing I want to share about number 9. And number 10, again, this is not in any chronological order, But I chose this one to end on this one, largely because it piggybacks on number 9. We're going to talk about the market a little bit, but I've seen this come up on different forums and social media stuff like that. And it's something we've learned years ago when it comes to calculation of your return. And that's the rule of 72. Again, it piggybacks on number 9 a little bit. And you've heard me talk about it intermittently through previous shows. The rule of 72 tells you how long it will take your investments to double. So let me give you an example. If the stock market, in my example, earns 10%, you would then take 72, divide by 10, and it would be 7.2 years to double your money. So if you have $10,000 in an account and you were running a rate of return at 10% in 7.2 years, or 7 years, 2 months, let's say, right, it would double. It would go from 10,000 to 20,000. Now, if you move down the 10% to say like 8, for example, it'll take you 9 years and you can go from there. So it's just a good rule of thumb. It's definitely a fun one. I've actually seen it work for younger investors to get them, there's good parts about motivation, but to get them motivated around looking at money. Now, whether or not you're watching and listening to me right now when let's say you're 80, you're 70 or 80, or maybe you're 20, it really doesn't matter. I mean, the rule of 72 is the one on this list that will probably factor more in about your time and time being involved in these scenarios. But the rest of them are really good, pragmatic rules that I just think I get a lot of questions on them. And this is just coming from an experienced advisor that I wanted to share with you. Again, these 10 items that to bring up, share with you. They're good rules, good money notions to take hold of. And just to remind ourselves, as we march into this new year, many of you might know some of those things that I just mentioned, but I really, want to, on this episode, on this show, bring in the context. I think it's a good contextual planning strategy. You can start on your own, start the year fresh, and write that list down. Go through these items, share it. You can reach us out at Make Your Money Matter on social media. We'd love to hear your comments, love to kind of get some discussion on that. If it's been successful for you on some of those things, anything like that helps, because other people, what I've noticed in our community now, have been actually sharing some of the notions we talk about here on the show that either works for them or they've tweaked it to make it work for them. And so what I've noticed in this world of social media and the world of YouTube now and doing this show is that it's actually a really great community to share some of these items as we go through. So, take any one of those 10 lists, right, that I just mentioned. And again, there's more that I can go into, frankly, but those 10 I think are paramount. They're like first base scenario. Like don't think about trying to get a home run and a grand slam. Let's just get first and second. Let's start rounding the bases. And if you start doing that and getting your steps in and getting your stuff in order, you'll end up coming home safely. And that's the ultimate goal, right? You can call it retirement, you can call it what you want, but the reality is it's becoming financially free with your money. Okay, it's time to answer your questions. Again, if you have a question or topic you'd like me to address, you can leave a comment or a question in the comment section. Or again, if it's something you want to talk with me more one-on-one, you can just go to the About page on this channel, send us an email. We'll always keep the questions I read here anonymous. Never have to worry about your name being shared or anything like that. But we would love to hear from you. That's the whole point. And the question that came in is actually a great one. It's very topical given where we're coming from last year into this year, and is, are CDs, certificate of deposits, a good place to save money? Great question. I'm going to go back to one of the rules I mentioned on my 10 list today around short-term savings and how that relates to your cash position. If you recall, what I said was you want to have a emergency fund, if you will, of 3 to 6 months of overhead. So again, my example was if you have $5,000 a month as overhead, you want to have somewhere between $15,000 to $30,000 of emergency fund. Anything on top of that, for example, starts getting into the investment world. And this is where right now, given this last year where interest rates have gone up, the one positive sign about interest rates going up is you're getting paid for your cash now. So yes, anyone who's in cash right now should find a solid money market fund. And there's plenty of custodians out there right now that are paying very handsomely that is liquid. The thing about CDs I don't necessarily want to, I want to caution people with is the lockup period. The further you go out, whether it's a 1-year CD, a 3-year, or a 5-year, the further you go out, you have something called interest rate risk, right? So you may get a really good rate now, but those rates might go up and you can't get out of it because you have a locked in rate situation. So just something to take hold of there when you're thinking about a certificate of deposit from a bank or a credit union. There's money markets right now that are paying handsomely. You can look at it's up very clearly on a lot of custodians and a lot of platforms, a lot of banks, that's liquid. And I'm a big believer in liquidity, right? Because we don't know, maybe it's $100,000 you have set aside for a house you're looking to buy this year. You're not sure when that house is going to come up, so you don't want to lock it up. Money market or savings account that is yielding more than just 10 basis points like it's been doing for 15 years. The best part about rates increasing right now in 2023, and that's we've seen from 2022, is you're actually getting paid to hold cash now. Relative to inflation, it's not as much, obviously, but it's very healthy compared to where it was for many, many years. So great question. I know the question was largely directed towards CDs, but it's really more of a cash question. I think it's really important to bring up there. And when it comes to your cash, two things. Bifurcate what you need for emergency savings, and then the rest of it that you want to keep in cash. Maybe it's for a house purchase, a car purchase, a paying down debt. You're just having cash. Make sure you find some good yield because it is out there right now. Again, if you have a question or comment you'd like me to read here, you can leave it in the comment section, or you can email us in the About page on our channel. Before we go today, if you found anything helpful and want to learn more, you can visit our website at onecapital.com. You can also call or text us. We want to help. There's no pressure here. We don't treat people like a number. We value our relationships. It's the lifeblood of what we do. So click, call, or text us today. And if you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I often say, if you enjoy the show, share it with someone you like. That's the goal of this year is to share this community we've created here on the Make Your Money Matter show, because it's titled that way for a reason. It's making your money matter. So if you care, you have friends, you like the show, you want to make it matter for you and for them, share the show. I guess if you don't like it, share with someone you don't like. But until next time, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.